As a trader, in order to stay profitable and stay afloat, you should be able to actually identify key levels in the market, because these key levels actually defines how the market reacts. Now there are so many key levels you can identify, and as a trader, if you can't identify any of these key levels, it basically means that what you are in the mud and you are going to be stuck in the mud. But then you don't have nothing to worry, because if you watch this video to the very end, you are actually going to get out of that mud you are stuck in, because in this video I'm going to share with you some key levels that you need to look into in the market if you really want to stay afloat as a trader. These key levels actually involve your supply and demand levels, which are very important to market movement. And secondly, you should be able to identify your stop losses and take profit levels, because some of you identify some good levels in the market, you take your trade, but then you actually don't know where to get out of the trade, which actually lead you guys into taking more losses than profit, because you don't know where to put your take profit nor your stop loss. And in this video I'm going to identify these levels for you, so that what you can actually improve as a trader. Now, this already said, if this is your first time here, kindly help me do the YouTube business by smashing on that subscribe button. Also like this video, because I focus on creating videos on how you can actually improve as a trader. So let's get straight to business. So guys, now that we're on my laptop, let me take you straight and actually share with you these tips on how you can actually identify key levels in the market. Now, for example, here I'm going to use this particular trade here on GBP USD that I actually shared. Was it last week? I'll be last 2 weeks. So I actually shared this signal here on GBP USD. You can see it clearly when the market was actually moving bullish, and we were actually at a, let me go back. We're actually at a 1:4 risk to reward when I told them that I'm actually closing everything off finally. So that was already at a 1:4 risk to reward. So I'm going to use the same setup as a tutorial in this video, so that you guys will be aware of the setup and how I actually come about with my setups. So for example, the first thing I do is that when I come over to the market here, the first thing I look out for is market shift. I want to see where the market shift is, to see if the market is an uptrend or a downtrend. So basically, as of when I was doing this tutorial here, the first thing I did was get my market shift right here. So for those of you who don't know, market shift is the same as change of character, because I want to look if I should be looking for buying opportunities or selling opportunities. And for me to make this decision, first of all, I need to see where the market is creating the major market shift and the break of structures too. So the first thing I do when I get on the chart is basically identify my market shift and break of structure. So here's another break of structure right here. And then here we have another tiny break of structure in here, which gave a high momentum movement as well. And then we have another break of structure right here. Next up, we have another break of structure right here. So as of when I was doing this setup, this was how the market was actually is. So basically, after marking out this market shift and break of structure, I come to a conclusion that the market is bullish, meaning it's an uptrend. So I should be looking for a buying opportunity based on my setup rules. So now we've identified one of the key things to identify in the market is simply identifying the market trend. And to identify the trend, you basically look for where your last market shift is and then where your last break of structure goes. So in my own scenario, as of when I was doing this setup, the market shift and then the break of structure all were pointing upwards. So now after this, now we need to identify the next key level, which is after identifying where the market shift and the trend is going, now we need to look if we are going to buy or sell. So since the market was trending upward, I knew that I have to sell. So for me to sell, I need to come to the next key level to identify the market, which is actually my demand level. I mean, for me to buy, which is the market was trending upward, so I had to buy. So for me to buy, I had to identify my next key level, which is the demand level. So for that, I had to look in the chart. Now, when I'm identifying my demand level, there are some things I look into. The first thing I actually look into when identifying the demand level is simply momentum. What I mean by momentum is that from that area whereby the market created a demand, there should be a decisive move away. It shouldn't be some sluggish ranging system around the area. So I always look at decisive movement. And secondly, I also look at candlestick rejection around that level as well. So for example, if you should take a look at this level right here, here is the demand level I marked here. You can see clearly that here is the demand level right here, and then you can see that this candle actually rejected off here pretty much smoothly after retesting this previous break of structure. And at the same time, after here, you can see that there was a decisive movement. You can see the candles move away heavily. Now this simply means that what I've identified my demand level because I followed my supply and demand rule. So for those of you who actually want to know the full rules I follow when I'm identifying my supply and demand levels, you can basically watch a video that will be tagged in the description, or you can simply let me know that in the comment section that you need a video to my complete supply and demand identifying video. Then I'm going to reply your comment to that particular video that will share with you every single thing you need to know about identifying supplies and demand. So in this video I only talk about what the momentum. So here I had a momentum here, and secondly, after that, the next thing you look for in order to qualify your supply or demand level is simply liquidity. Now in my own case, the liquidities I often look into is simply double bottom or double top sort of liquidity, and secondly I look for another demand level sort of liquidity. And in this particular video, what I had was what another demand candle sort of liquidity. So here was that particular area. So this area becomes my area of liquidity. So guys, after identifying the liquidity level, now the next thing we'll look for in the market is basically where are we going to set our stop loss or our entries and then our exit. So now to identify this other sort of key levels, the first thing here we should talk about is simply waiting for the market to come to our entry. So basically for me, I patiently waited for the market to come to my entry at this area. So I wait for the market to tap into my supply or demand level. So in this case, it was a demand level, so I had to wait for the market to tap into it. And you can see it here that what the market came to tap into it. Now after the market tapped into it, this is when I will actually look for my exit level, which is where I'm going to take my profit. So now when I was looking at the charts, I would say I did not see any supply level or anything. So when I was looking at the chart to mark my take profit level, the first thing I did was what? Get the nearest highs that the market created, and this was around that level. You can see around this area looks more like a resistant level in the market, because you see the market test, it fell off. Let me position it well. You can see the market test, it fell up, test, it fell up, break out of it, fell up again, and then test it and fell up. This basically means that what this area is a strong area of probably where a lot of others are occupied in the market, which basically means that what this place is a good area for my take profit. So basically when you're identifying your take profit levels, if you are buying the market, if you are in a buy position, make sure that your take profit should be at the next supply level or the next support or resistance level. This is very important because the market might get to that supply level and quickly react off, or if it's a resistant level, there's a 80% chance that what is going to reverse after testing that level. So for that reason, when I see a resistant level, I often use it as my take profit target. And in this situation, I actually used a resistant level. So basically means that we've identified our next key level here, which is the take profit level. And to identify this take profit level, we basically use what we call the identifying the nearest key level. This could be supply or a demand or a resistant level in a buying market. So for that, I'll basically come in here and then set it here. So here was my entry after the rejection, and then here will be my take profit. And now after this, the next thing we need to identify is simply the last key level that we need to identify is simply our area of stop loss. Now one big mistake a lot of you traders make is that you get into a trade and then the trade suddenly goes and hits your stop loss before going into your direction. Now the main reason why this could be happening to you is simply because, now first of all, before I give you the reason why, this is normal, it's 100% normal for this to happen in the market. But for most of you, the main reason why this could be happening on a continuous basis is simply because you often set your stop loss position at a very wrong level, because you just set your stop loss at a random level, which you don't really care what could happen there in the market. Now basically, when it comes to setting a stop loss level, there are two rules I always use. Rule number one is basically keeping my stop loss below the wick of the candle that I actually use to identify my supply or demand level. Or secondly, I just keep it some pips below the candle that I'm using to enter. So all totally depends on the market reaction. But in a normal situation, I will advise you your stop loss should be some pips away from your from the bottom of your key level. This could be your supply or your demand level. So in this case, basically, here was my stop loss right here. So that one is to 4 point something because I was observing the lower part of this candle here. Okay, so this is at the low of this candle. So basically this was my 1:4 target. So now you can see that how I basically do a full setup with you right now, giving you how I actually identify my levels to enter the market and get out of the market. Now basically this every single thing that you need to actually be a solid trader. These are the most important key levels that you always look into in the market. Now let me go back on them again. The first one is simply identify the market direction. Now, for you to identify the market direction, you need to mark what your market shift and your break of structures, because where they face totally decides where you should trade to. If they are all facing upward, meaning you should be looking for buys, and if they are all facing downwards, you should be looking for sell. Now, after that level, the next level we look into was actually our supply or demand level. So since it was a bullish market, we look at the demand level. So when we got to the demand level, I told you that for you to identify a demand level, you should first of all look at the momentum, make sure that there's a decisive movement away from that level. Now after that, after we got that ready, the next thing we look into was our liquidity level. Now as I said, the liquidity level could be a support and resistance level, or it could basically be another demand level. Like for this situation, it was a demand level sitting in front of this particular demand here, because when two demand are less than 30 pips away from each other, there's a high. You can see this one was just 16 pips, and in my other video I stated it clear that if the two levels are less than 30 pips or 40 pips away from each other, you should see it as a liquidity level, and that's exactly what I did here. So I saw this demand level, I had to mark it as my liquidity level. So if I had seen a double top before, I also mark it as a liquidity level, because the reason why this one's a liquidity level is simply behind these areas there's always a lot of pending orders that the market is waiting for. So the market, no matter what, the market will surely come and grab them. Now after that, I had to wait for days. The market came back here, still I didn't get in. I had to wait till the day the market actually came to tap my level. Now after the market tapped my level, the next thing I looked into was what I identified where I will get at in case I get into this trade. Now this boils down to my stop loss and take profit. Now for the take profit, I look into the market and I noticed that there was a major resistance within this area. You can see market test this level, fell off, test it again, fell off, test it, fell off, break above it, and then quickly fell in again. Now this one shows that this is a key area of resistance that the market is likely to react from next time it gets there. So what did I do? I marked that area as my area of take profit. Now after that, when it comes to the stop loss, as I said, always keep your stop loss below the wick of the candle that actually marks your supply or demand level. Or basically what you can do is simply, when you're marking your supply and demand level, you can just box the whole candle like this. Just get the whole candle like this and make sure that you are like a bit below it or something of such, so that in case the market reverse to come and sweep the liquidity around there, you will still be okay in the market. Because I had similar situations whereby the market dips way down close to my stop loss and then boom, suddenly reverse back. That basically happens on GBP JPY for me a lot. So basically this was how I got that 1:4 that I shared to you on Telegram. So basically I'm using a trade that we all traded together for this particular tutorial. So now if I should go back in time, I should be able to see this setup as well and use it as an example. Let me see if I will be able to actually spot that particular setup. Okay, so here was the setup as of the day I made the setup. Here is it. You can see it here. The level here, my stop loss right below it, my entry, and the take profit was actually at this original top before I had to change my mind due to how the market was actually reacting for a few days before the market actually came to my entry. So I had to readjust and bring it lower. So when I took this trade, I also took another trade on AUD USD using same approach. So basically this is all I have to share with you in this video. If you are able to comprehend this video and then take your time, like our advice, take your time, rewatch this video as many times as possible and identify all these levels and see how they actually react in the market. You can go back to your chart right now and look for these areas in the market. You see that whenever the market comes to this area, it always reacts to them. So this is all for this video. See you in my next video, and you can also join my Telegram channel to get my free signals as well. So see you in my next video. Bye.